if anybody reads into this, you're an idiot and should lose all your money, because I don't have any connections and I'm not saying anything along these lines.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate, and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
We are back. Welcome, and thank you for joining us for another edition of the Daily Dots. I just happened to notice some. Do you have Zach? Is the word Zach written on that can? That pop can?
I don't believe so.
Over there? That is so weird. My screen was like superimposing the name Zach
Nice.
from this angle. And I was scratching my head going, what in the world? Weird. Ghosts in the machine. Anyway, and as you can tell from this chaotic start to the old cast here, or the pod, or whatever the heck you want to call it, I am also joined again by the brain trust himself, Mr. Chase Taylor. So today was the last 15-year Redux Day. Market not doing much of anything. A pretty quiet day overall, except Meg 7. Yeah. We had a party in Meg 7. Pretty solid earnings though coming out of some of those companies.
Yep.
So not a surprise there.
I would say,
yeah. Which, again, I'm not going to go down the valuation rabbit hole again, but it's why it's so fascinating to watch some of these companies like the Apples and the Teslas that are trying to get run up and trying to rally. And you look at what those companies are up against, and then also it's inverted, right? Like, so it's funny because in this circumstance, not knowing anything else, you just dropped me in, if I hadn't been here for the last 2 or 3 years, and you kind of showed me the landscape, I would think that an Apple and a Tesla in this environment would probably be the cheapest Meg 7 names, because they're up against it the most, right? You'd figure they'd be nailed the most.
Yeah.
It's the exact opposite. The companies that are doing the best,
I hadn't even thought about that from that angle,
are trading at the cheaper valuations, and the companies who are literally walking dead into the storm are the ones trading at the frothy ones. It's just everything's upside down. It's bizarre. Because I mean, you and I were talking, and I'm sure that caught people off guard. It didn't us, thank goodness, which is why we had positions in, Amazon, Meta, and Google being main, and we've got a trading position in NVIDIA right now. But at these valuations, where we pick those companies up at, based on how they're growing, I think that's one of the things that gets lost with so much of this nonsense and froth around. I mean, you can go in there and buy Google right now. I think the cheapest valuation I've seen it trade at since COVID. Meta wasn't quite there, but I mean, you were flirt.
I mean, it was pretty reasonable.
Yeah,
I remember we looked at all of them, and their forward PEs were basically, call it in the same neighborhood as the lowest they've been in the last 10 years.
Yeah, and their growth, none of their growth had slowed down. The ones whose growth has really been hit is Apple and Tesla, and they're trading at the richest valuations. It's really, and again, that's why I just think it's a stock picker's market. There's value to be had out there. It's just not in the indexes.
I think Microsoft's in the middle where it's still expensive.
Yeah.
But they're executing on a level where it's like, well, I don't know if your cloud business can keep growing at 30%, whatever.
Yeah. Yeah. They're cranking still pretty good. The other thing is with Microsoft is, and I guess it's not that different from from the other tech names, but again, I just look at Apple and Tesla, and those businesses are so dependent on like single products where you look at now, I mean, Amazon, 80, 85, 75, 80% of their profit comes from AWS. So, I mean, they're pretty reliant on that as well. Microsoft as well. I'm sure if we break down the numbers, Azure was probably the vast majority of their performance, their growth. Yeah. So that dividend is not going to go on indefinitely, obviously. but it does open up another thing, especially for those companies, which again is odd to me that they're the ones whose valuation has been compressed, and Tesla and Apple are still trading where they're at, because one of the theses here, right, about globalization coming undone, trade wars, that you're probably that the upward surge or the upward trend in the dollar is breaking, and that you're probably going to be looking at dollar weakness, right? Well, if that's the case, and one of the things you've pointed out, that should be wonderful for Google's business, for Meta's business, for Amazon's business, because the fastest growing parts of their business just got cheaper, and they already outprice all their competitors, right? So, those things at those valuations. The other thing I was thinking about today, or the other day, if anybody reads into this, you're an idiot and should lose all your money, because I don't have any connections and I'm not saying anything along these lines. But you start looking at a valuation on Google. Google's starting to kind of remind me, honestly, of Apple when Buffett bought into it. Remember, it was trading at like 15, 14 times earnings, and it was growing like a weed still, and you're just kind of like, it just wasn't getting the love. You know what? Honestly, at this price, I wouldn't be surprised if he rolled some of those Apple winnings into Google here.
I've been saying this for, I don't know, at least 2 quarters. Like, I don't understand why I didn't own Google.
I think you're at a price where I would not be surprised if we found out that while we're recording this show right now.
I mean, they took a shot at Ulta. We're not going to take a shot at Google here?
I don't.
Fortress balance sheet, like everything.
At that multiple, and then also looking at what the breakup value would be. I mean,
maybe the AI CapEx is keeping them out of that and stuff like that. They just don't want to deal with it. But
well, why is that the only company that's pricing in AI CapEx then?
I mean, it's not, but I'm just saying that maybe that would be something that would hold back a Buffett, where you have this super asset light business model that all of a sudden isn't so asset light, and they got to spend hundreds of billions to do infrastructure, and it's like, no, thank you.
Well, yeah, but and I don't know this intimately enough, but Google also has angles that I think would allow them to absorb that CapEx spending in a better way than the other. Like, for instance, their chips are really coming along, their own chips. And, I'm not a chip expert. I don't know how close they are, or how applicable that is, or what it could, but yeah, I mean, that CapEx, I understand. Yeah, I understand what you're saying. But that underlying business.
Yeah. Preaching to the choir.
Yeah. No, I know. You and I both. And like I said, I think that's the way you have to look at this market. I think that we've all been so used to looking at indexes, because that's been the game over the last 15 years. And, and that's the more and more I think about this. And that's one of the reasons why I don't see this bottom opening up and having this catastrophic 0809 style drop. And the reason why is because there's so many things. There's so much ridiculousness and idiocy in this market, but it's on both sides of the ledger. Right. So really what I think you're looking at is, I think if you're riding the indexes, you're going to continue to get a lot of nothing. I think it literally is the inverse of the environment we've been looking at, where there's great stuff to be had, but it's just the indexes, you're going to get too watered down.
Yeah. I think it's become a little bit of a cliche the last few months to say, ooh, it's going to be a stock pickers market.
Yeah.
But
I think it is.
I think this is true this time.
Yeah.
Finally, maybe.
Yeah. And I think that,
and a country pickers market even, but
yeah. Country indexes, I think is a good one. But I mean, you look at the index, and I'll just say it to you right now. I mean, look at the S&P 500. There's too many things in there that have too substantial of weights at too ridiculous of prices, where I just don't want to own that. I mean, in aggregate, the entire index is historically extraordinarily expensive, but it's not because blue chips are trading at 25 times earnings rather than their standard 18. You know what I'm saying? Because usually markets are like that because it's the smaller, or the smaller cap sectors that get really frothy and really push them up. And that's the thing about this market that's tough, is a lot of the stuff you're afraid of is it's the top of the index with the heaviest weighting.
Yep. Speaking of, so today on the S&P, we hit the 61.8% retrace. So I went and looked at.
Did we close right on it?
Below. It kind of rejected it so far. You go look at small caps, they haven't even hit their 38% retrace. So they're not even close to retracing half their loss. I mean, barely a third. And yet S&P's at 61%. I just found that interesting. They they lose on the downside and back on the upside.
Yep. They don't have the megs, man.
Yeah, they don't have much of anything right
No,
now.
no. What else do we see today?
You mean to run through the market real quick?
Yeah.
So S&P closed up 0.63, and we were up over 1 most of the day.
Wow, it gave
Yeah.
boy, this market gave a lot back
Good
at
bit
the
back.
end, which is the last week and a half. I felt like we were back in the last half hour of the day rally mode every single time.
And it's worth noting, I mean, this was eighth straight up day. Q's ended up 1.3. I see an after hours down 0.6, so something must have spilled and on earnings or something. I don't know. Small caps are up 0.6. Equal weight closed down on the day. So equal weight was down 0.14 for the day. So really this was just Mag 7 being up 3%.
Doesn't Apple report today?
I don't remember.
It wouldn't be out already though.
Oh, it does report today. And I want to say they always take forever.
Yeah.
You're down a time. You're up down the same as the index after hours today.
I wouldn't, you know what, honestly, I would I mean, we're short a small position of Apple here, but we don't have a big dog in this fight. If you were to make me guess right now, I would think that they probably have figured out a way to pad it for this. I would expect
the phone front running may have been enough to help them out.
Yeah, I think they're probably going to post a little bit better than expected quarter would be my guess.
Oil finished up on the day about 1.3, 1.4, and that was because President Trump basically threatened other countries not to buy their oil. The fact that you can only bounce 1% on that's kind of wild. Gold down to about 2.5, silver down 0.7. The dollar was up 0.5, so the dollar, like I kind of alluded to this yesterday, I think, but you had sort of an inverse head and shoulders where it looked like it was about to rip higher. It does look like that's triggering and happening. And then yields, for some reason I honestly cannot explain, the market has decided that the chances of a recession are getting a good bit better. So you have the 2-year yield up 8 today, and then the 10-year up 4. So you're pricing out some cuts. I think that's obviously incorrect, but yeah, so that's where we were at. And then for data today, we had
look, and I honestly, before we move on, I don't want to cut you off if you forget to where you are or forget where you were, but now we'll see. I think this is going to be a great real-time experiment that we can do with the listeners here. It has been our experience, and something that you have talked about, that this is one of those classic moments where we're looking at the data. We have an outlook that looks very obvious to us, and yet price action is going the opposite way. Okay. This is very consistent once again with exactly what we were talking about happened heading into COVID, right? And you and I have also said that one of our biggest mistakes over the last 4 or 5 years is listening to the price action, which is, guys, and when I say this, I'm saying this humbly because this is almost like inverse logic that works in markets. Usually, if the price action is moving against your thesis, you're almost always better off to abandon your thesis and go with the price action.
And I would say, and one caveat, 23
the
market was right. We were wrong.
Yes.
And we should have listened.
Yes.
But in a moment like a COVID or like a trade like flare up of this magnitude, like that's different.
Yes. Because it's a complete change of course, right? It is you and I erred in that call, and I'll speak for myself specifically, but my error in that call was just thinking that the sugar high would stop early, right? The kind of the data that we were seeing at the end of this last year coming into this year is what we were expecting to see about midway through 2023. Yeah. And I just underestimated how much cash and liquidity was out there and all that other kind of stuff. But there have been multiple of these situations where, I think back to the gold call that we had in 2016, where we were like, okay, everybody's saying that when interest rates start going up, gold's going to get killed. That's ridiculous for reasons we've discussed before. This feels like one of those moments, though, where normally the right thing to do would be to abandon your thesis and be like, you got to listen to the market. I very much believe that's incorrect here. And I think it's going to be a great opportunity to see once again if that paradigm plays out. And again, it would be really interesting if people have talked about this, or if I have not run into it anywhere. I haven't seen it, but I'm sure someone's done some work on this. Something about this environment, and maybe it's just retail involvement, maybe it's just froth in general, but something about this environment has retarded the market's ability to price bad things in. even when they're freaking obvious, even when you know they're happening. I remember, and I'll go back to the COVID one. I'll never forget that day where I called my friend that works at Microsoft, and they're like, Zach, is anything bad gonna? They go, it's already happening. They're like, we already can't. We're frozen. She's like, we're all sitting here talking about we don't understand why our stock's going up, and like I didn't call anybody on the board. Right. I mean, she's super smart and has a good role there, but I mean, it's not like she's connected to the executive council or anything like that. And just nobody does any work anymore. It's the strangest thing. And it's like what you see right now. Like if you just looked at market price action, you would look at this market and you'd be like, oh, there's a little growth scare, but this market is looking through it. Well, that's not what's happening, right? You're looking at potentially the largest trade war you've had internationally since
it's the biggest trade barriers in 95 years. So
95 years. Yeah. And the market's like, whatever. We don't even think there's going to be a recession. Yields up. Now, again, if 3 days from now, Trump does an about face and drops everything back to 10% internationally.
Yeah. The market sniffed it out and it was right.
Yeah.
Sure.
I just don't see that happening. Like you and I, and this was your observation. I mean, if people want to give me credit for it, I'd be happy to take it. But market bidding against itself. You're sitting there going, hey, as long as the S&P is above 5,500, and truthfully, probably even lower than that, as long as it's above 5,200, and you don't have a 5 handle on the 30-year treasury.
Yeah, then they can tighten the tourniquet and feel good about it.
Yeah.
Yeah, for sure. To go back to the data that confirms what we're talking about, it's still bad. ISM was better than expected, but still 40, under 50. So it's in contraction.
Yep.
You have prices paid in there ripping higher, which is going to create some stagflation.
Yep.
Important to me was job cuts, Challenger Gray's job cut announcements. And last month was the second worst print we'd ever had. This month it got a good bit better, like less worse. So I saw tons of people talking about like, oh man, down 62% or whatever from last month. And like just talking about it like it was an all clear. And it's still an incredibly high number. But if you do the 3-month average for job cut announcements, I mean, you're absolutely in recession territory. So that's not helpful. And then you go over, look at jobless claims, which have been relatively muted to this point. Those popped higher. They were about 20,000 higher than expected on initial. And then you've been consolidating in a really tight range on continuing jobless claims, and that just higher out of that to a new high for the cycle. So you're seeing the labor market weaken literally in real time. And that is the keystone to all things recession or not recession is jobs, period. Yeah. That is the first domino that you knock over. So, so to have all that data hit on the same day that yields are up and it's kind of wild, especially given the totality of data for the week, which has been very, very bad. And then obviously tomorrow, the granddaddy of them all with the jobs report itself, which will be important given the backdrop of all this. Though I think the one next month is going to be that much more important because it will encapsulate all of this and not just like a week of it.
Yeah, I keep thinking about volatility. And the reason why is I've said repeatedly, and we don't need to go over it again, but I don't see a giant, morass or a 40%, I don't get the sense we're going to see the ground open up and just swallow this market. That being said, the further you go through this process, if our thesis or actually, I guess, beginning of a thesis is correct, that for whatever reason, this market has become spectacularly blind to risk and refuses to, for whatever reason, price in bad news. If that ends up playing out this time, I think this situation is uniquely complicated with enough complicated crosswinds to really set up a dangerous dynamic because, for instance, the numbers you see, we were talking about it yesterday. I literally saw articles that were kind of poo-pooing the bad negative GDP print by saying, but look at consumer spending. And I just sat there and I was thinking about this today, but also when I read it, I went, boy, man, yields going up, right? Oh, people don't think there's going to be a recession, but you still have foreigners repatriating capital. There's so many things that are giving false price signals in this market that I think that it increases the chance of having a really nasty market event. You know what I mean? Where all of a sudden you wake up one day and you get this abysmal print on jobs and people go, what happened to the consumer spending? You know what I'm saying? It sets up the potential for this moment where everybody's looking at all this data and not putting it in context. And all of a sudden, you open the door and you realize there's nothing here.
Yeah. And to go back to that jobs being that domino, if you get that first layer of job losses, that's when you see the spending just go.
Yeah.
Like, because people, normally like spending doesn't just go like deeply negative. Like it just slows down to about nothing.
Yeah.
And that's a big deal when the American consumer just flattens out hard.
Yeah.
Just look at the earnings. If McDonald's is struggling to make money, and Chipotle and Starbucks,
Nike,
like, these
Starbucks,
are like the staples of people's everyday lives, and their earnings and the commentary around their earnings is pretty bad. Like, so to see that at the same time, they're like, oh yeah, but consumers are still spending. It reminds me of 23. There were periods where the consumer wasn't looking great, but then if you went and listened to the transcripts of any of these big, companies that service a bunch of people, they're all like, you guys are on drugs. Like, everyone's buying our stuff. They'll pay anything for it.
This is a really good point.
And because I didn't listen to it enough, I'm like, I don't know.
Yep.
And then now I look back.
We just
now
thought
it's the opposite.
Yeah, we just thought spending was going to hit a wall, and it just didn't. You're right, though. I hadn't thought about that. Right now is the exact inverse. It's the mirror image of that scenario, right? Where everybody's like, well, look, consumer spending's still fine. And you listen to the companies and they're like, dude, they're pulling in their pockets.
Yeah.
They're even companies who have
and they have great data now. They understand their shoppers in a way that there wasn't a thing 10, 20 years ago.
No, you know what? And that's another thing.
All these reward points with the scan, you know what I mean?
You have to look through that. That's one of the things that has really impressed me and frustrated me at times is that they have gotten so much better at feeling the rhythm of their business and understanding where it's going on a quarter-to-quarter basis. You do not see the giant misprints. You do not see the giant missed earnings numbers. They're so rare. And I think it's because these guys have such great look through to data, right? And they have so many big data ways to crunch it, to look at it, to analyze it that they didn't before. And when they're coming out and saying, hey, we're pulling guidance and it doesn't look good, you need to listen, It's pretty wild.
So even like Besson, I think earlier this week was touting like, oh, the consumer's still spending, and like, yeah, they are. It's just, but when you understand the sequencing on the way this tends to go down, first of all, you tell people, like, essentially tell them, hey, your costs are going to go up on most of your stuff here pretty soon. What do people do? They go and get ahead of that and they buy stuff, like, obviously. And then, but at the same time, you look at all the survey data, like, how do you feel about your future employment? And people are starting to say, terrible.
Yeah.
And that conference board one that says, where employment's going to be in 6 months, like, you're really good at getting it kind of right whenever it comes to inflection points in unemployment. It's never inflected higher, and then unemployment didn't follow. So they're maybe right about that. And if people really feel that way, I would assume they're going to spend less. I mean, I would be shocked if the consumer doesn't bring it in.
And that's
this quarter.
Yeah. And that's what's really hard. That's why it's very hard not to take the threat of recession seriously and not think that it's potentially knocking on the door right now. And the reason I say that is, profits are the lifeblood of an economy. And when you're at maximum employment and you also happen to be at all-time record margins for your main companies, in our case, it's the S&P 500, and a trade war kicks off that's marked with tariffs, right? The tariffs aren't going away. Now, they could come down drastically, but what does all that mean? All of these things point to lower corporate profits.
Yeah.
And these guys get paid. What is the easiest way to juice corporate profits in the long run? Cut labor.
Yep.
It's like, This isn't rocket science.
I was talking about with Jason this morning, like, because I've been watching that for like a tipping point when it comes to hiring and or more to the point, firing. Like, if you think about, I mean, COVID, a lot of companies got caught without enough labor, and they really struggled to get enough after. It became like a Hunger Games for labor.
Yep.
Because we were running the economy so hot. I think there's so much PTSD from that everyone's like afraid to let people go. And I've been saying this for 2 years now. So, but I think you get to that point where it's kind of obvious that the thing to do to make it through is to let a few people go. And I think when 1, 2, 3 businesses in the neighborhood let a couple people go, everyone else is looking out the window and they go, oh, it's okay to let people go now because it won't be a Hunger Games. And then the other big thing is if you see a large cap company that hits a skid and it starts to have a problem, and they announce some pretty decent sized job cuts, and the stock gaps up 10% because they let people go, and that kind of thing does happen. That's where I think the rest of the companies go, oh, that's the secret. Let people go. Okay.
Yeah. Exactly. The same stuff that fed into it. Right. Stock-based all the things that everybody starts doing, stock buybacks, right? It starts working that way on the inverse. And that's what that to me is what is, it's funny we're talking about this now because it's kind of coming more clear to me. That to me is the part of this that's so much like COVID, meaning it's the certainty of negativity, meaning like when we saw what was happening in China, we didn't know the magnitude, but we knew it wasn't good, right? Like market. Okay. Same thing. What is happening today, even if you get a positive, timely resolution, what has already been in place will squeeze profits, okay, into an economy that was slowing already, right? That's best case, right? And I'm not going to go as far as who said this the other day? Oh, Jamie Dimon. He said, look, I think a recession is a best case type scenario. He thinks, I think far worse outcomes are your base case. So, I don't know if I agreed that strongly. I think that's a little more forcefully than I would put it.
I think that would have been fair before a lot of these carve outs and stuff hit. But now that the trajectory is to do less and less, obviously. So I think it's a little forceful too.
The other thing is it just very much also feels to me like you have finally hit the end of the sugar high. You know what I mean? Where it's very much sputtering. And I just think that when you look at the levels of inputs and the levels of stimulus and the levels of, helicopter money, it's taken longer than we both thought. But I do think you've reached that point where a slowdown or even a recession isn't necessarily only going to happen because something bad is going to happen. I think you could just have a recession because you don't have this unbelievable inflow of capital, liquidity, and all that other kind of stuff. That, you know what I'm saying? Like,
like if you think about it, the sugar high you're talking about, like I think that sugar high from COVID stimulus, I mean, it was just stronger than we thought just in general, but I think it created more of a flywheel effect than we recognized.
True.
But what now I feel like people on the other side don't recognize is that flywheel effect isn't, indefatigable, to make up a word, I'm pretty sure. Like, you can stop the spinning of that flywheel with things like some job losses. I mean, just talk about real income. Like, I'm not saying inflation is going back to 9%. I'm not even saying it's going back to 4%. But what I will say is inflation is going to go back up.
Yeah.
Just because of the tariffs. To some extent, they go up because prices have to any extent that the company that sold it to you ate the cost. That's all margin for them. So both are bad for the economy. But to the extent we get that inflation and we get wage gains go down as the labor market loosens up, both are starting to happen already pretty significantly. That's when you get that real income squeeze. And one of the reasons we've had such a great consumer in the last 2 years, like, real income has been pretty good.
Yeah.
Like, inflation adjusted income growth has been nice, and it's not gonna
historic,
it's not gonna be.
It's been historic. Forward. I mean, it's been historic.
So it's again like forward looking. I mean, how are earnings great when real incomes get squeezed hard, right?
It just doesn't. I mean, and that's what I was saying is I kind of feel like I've been the guy that's been blindfolded, stumbling around the room, trying to figure out why, what aspect of this reminds me of COVID, because it is so similar in terms of the way the market is looking at something else. But that's it. It's the certainty of the tariffs that we know are going to be in place.
Yeah, it's just math problem, and it's
right. That's it. What we know right now is the opposite of price action that is occurring in the market. What we know. Now, the unknown is still there, but bottom line is what has occurred already is going to mean that earnings will be lower for the S&P 500 than the projections coming into the year. How much lower, we'll need to see.
So we've gone from about 12 coming into the year, 12% growth was the expectation, all the way down to like the 7s.
Yeah, it's got to.
But that, I mean, that's a pretty healthy assumption to get 7%. That's like,
I don't see
that's like the long-term average.
Yep.
And I agree with like, now it's been steadily leaking lower.
Yeah, I just not you again, and it's not because I see something horrible going on. I just think people are being very unrealistic about where margins and profits were already and how they got there. Meaning, like, I mean, there's not much juice left to squeeze out of that thing.
Right.
And if you had a market that was priced differently, it wouldn't be as concerning. But yeah, it's bizarre. And then
to speak of on the market not pricing this well, it's probably like there's a chance it's about to get a lot worse. We were talking about this earlier, but like in a mission yesterday, maybe Vol Control had started to buy, and then I was reading Tier 1 today, and they were like, no, they haven't bought yet. But it looks like that floodgate is like right there, where a couple more days, maybe even one more day of decent realized vol, and then the Vol Control people come in with a fire hose to buy. And so you could push this up a lot. But if you think about it, though, every dollar of that buying is a dollar of future selling. So that trap we're laying for that possible 6,000 area, like in June, is just it's significant. Another thing to mention there, I talked about the Zweig breadth thrust this week.
Yep.
And how I don't sleep on that. It's one of the reasons I've been kind of like, pounding the table on some right tail hedging and stuff, because like this thing could rip. Simon White from Bloomberg did an awesome analysis of the Zweig breadth thrust.
When was the last time we had one?
23. So it's one of the reasons I take it serious, because I was bearish in 23. One of those triggered. Underlying didn't seem good, and I'm like, nah. Like this thing has a great track record, but way.
That was summer of 23. I remember that.
Absolutely ripped after. So I was like, okay,
wasn't that like June of 23, something like that? Yeah.
So I'm like, okay, this thing, I'm not going to doubt this next time. So it triggers again, and I'm like, all right, I'm not going to doubt it. But Simon White broke it out by if you have a recession within like a year of the triggering or whatever, or I can't remember what the time frame was, 6 months, I don't remember, and he broke out the difference, and it was basically no matter what, it goes up for at least like kind of that 6 to 8 weeks, recession or not. And then, but if there's a recession, then it rolls back down hard. And if there's not a recession, it just keeps going up. So you can kind of visualize that difference. And now the median, and there's been multiple of these, the median time that goes by on a Zweig like rip higher, if you have a recession, is about 48 days. So that puts you to like mid-June as to where, if you're going to go into recession based on this, and obviously like these like 80 grains of salt to take here, but so like mid-June would be a decent proxy for like market rips into that and then rolled over. And I think that's possible. Now I think we're going to roll over short term just because we've gone too straight up, on a very short term basis. But 6,000 mid-June, even though it makes no sense, just because.
Well, yeah, but you and I have talked about it. Where we're at right now makes no sense.
Yeah, but tell that to Vol Control that doesn't know what a fundamental is,
Right. No, that's why I'm saying. I mean, if you think that that would make no sense means it won't happen.
Yeah.
We shouldn't be here right now. I mean, it's crazy time.
It'll go from head scratching to head smashing.
Yeah. No, that'll get
over like a 6-week period.
Yeah, and that's why I think that you've got to be patient on this one. But I mean, from a fundamental basis, if you care about fundamentals, which we certainly do, I think it's pretty easy at this point. The longer this stuff stays on, the worse it gets.
Yeah, every day the market goes up and the tariffs don't go away, or we don't get meaningful resolution.
The funny thing is that's probably the pain trade too.
Oh, I mean, yeah.
You know what I mean?
Yeah.
Like that's the pain trade.
You go a little bit higher and everyone has to come back. All the hedge funds that sold have to come back. All the pod bros that sold come back.
Yep.
I mean, obviously the machines come back. You're seeing CTAs are already buying in a lot. So then you would just, I mean, everyone would be all in again, even if the underlying didn't get better.
Yeah. I don't even want to say, you know what? And I know I will say it because it's not bragging at all, but that's why. And if everybody's going to be like, well, of course. Yeah, no, I get it. But it's why it's so beneficial. And I've been on both sides of it. It's why I love having a substantial cushion and being green while the market is red in scenarios like this, because it just buys you more wiggle room. You know what I mean?
Yeah, you don't have to get it perfect.
No,
on that 6-week ramp.
Yeah, you can
get it totally wrong, but
you can de-risk and just kind of let things come back to you. You know, you don't have to be all over it. And boy, in situations like this, man, because I mean, I get it, right? Look, if people all start throwing money at it, if you've been managing assets at any level, you know, over the last 15 years, you understand that professional risk.
Yeah,
man.
Speaking of PTSD, like
no kidding,
the grab for mags would be through the roof.
Yeah, and I respect that fear. And the problem is it's like that day we saw the other day, you know, or not too, it was a week and a half ago. You know, S&P up 10.5% in a single day because they said some things about Chinese tariffs. You know, like that's just this market. Like you and I were joking around. You know, I said it before we came on. Well, Chase, you got to remember the market takes, you know, an elevator up and an escalator down. It's the exact opposite of the way it's used to be, but it's the market we have, not the market we want. It's kind of like heroes, right? You got anything left?
Nope.
No. So we're just going to keep watching. What data we got coming out tomorrow is jobs, right?
Yeah, some other random stuff, but jobs is the big thing.
That's what we're going to watch about. Speaking of which, Apple, I am assuming Apple probably did slightly better than projections. Stock's down 2.5, but not getting slaughtered. Based on, you know, I haven't read anything, but being down 2.5 based on this tape, I would think that was probably produced from a slight beat. That'd be my guess. We'll go read about it. But anyway, that's all we got for today, guys. As always, check us out on YouTube, on Know Your Risk Podcast. Also go to knowyourriskradio.com, sign up, subscribe, and get us on Instagram, TikTok. You guys know the drill. Anyway, we'll see you tomorrow. Have a wonderful evening. You're listening to the Know Your Risk Radio Podcast. You Know Your Risk Podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.